Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax accounting and business advisory firm. This week with Ellie Theochari and Gabby Donald.
I'm Ellie Theochari and welcome to The Tax Factor, the UK's top tax podcast. I'm so pleased to be joined by Gabby Donald, a VAT partner here at Blick Rothenberg, for her very first Tax Factor.
Thanks for having me, Ellie.
This week we will be talking about yet another challenge surrounding VAT on school fees, making tax digital for income tax self-assessment, and an Upper Tribunal anonymity application. Gabby, let's start with something very close to your heart, VAT.
Absolutely, Ellie, thank you. A topic very dear to my heart. There's been a lot of discussion over the last week or so around a major challenge for those schools receiving fees from local authorities in relation to pupils where the school is named in an education, health and care plan, or to give it its short name, an EHCP. To summarise, if a private school provides education which is funded by a local authority under an EHCP, that supply is taxable under the new rules, but the local authority will be able to recover the VAT charged as part of its Section 33 claim. Section 33 is a provision within the VAT Act that enables local authorities to recover VAT they incur in relation to their non-business activities, including education. Consequently, those private schools which make supplies wholly or substantially to local authorities may be feeling quite relieved. This may seem simple. They have been told that their supplies to those bodies are taxable, and those bodies have been told in turn that the VAT that they are charged is recoverable. Unfortunately, there is a little bit of a catch. In order to reclaim that VAT, the local authority will need to hold a valid VAT invoice for that supply, and therein lies the problem. Private schools can't issue VAT invoices until they've been registered for VAT. To break this issue down a little bit, there are 2 points that we really need to consider. Firstly, VAT registration, and secondly, the timing of the invoices. So looking at that first issue of VAT registration, most schools will either be receiving fees for the term commencing in January already, or will start to do so really soon. Most schools will therefore be in a position whereby they expect to exceed the £90,000 VAT registration threshold in roughly the next 30 days. As a result, they need to start thinking about VAT registering now, and that the date that will be relevant for their forms will be the date that they expect the VAT registration threshold will be breached in the next 30 days. Once registered, VAT on those January term fees will need to be included on their first VAT return. So timing of VAT registration, quite an important point for schools to be thinking about now. And just as an aside, I understand that HMRC have actually set up a dedicated team to process VAT registration applications specifically for private schools. Hopefully this is going to mean that the VAT registration process is a little bit more efficient than it might otherwise have been, given the numbers of schools that are going to need to register in a really short space of time. And also noting that historically HMRC don't have the best reputation when it comes to processing VAT registrations in a timely manner. So that brings us now on to the question of VAT invoicing. Whilst waiting for their VAT registration certificate to be issued, schools are advised to issue invoices for the VAT inclusive amount of the fees, effectively the value of the fees plus the value of the VAT that would be due. Whilst some parents and local authorities might try to push back on this, it's really important that the schools actually issue their invoices on this basis to prevent the risk of being out of pocket in the event that the fees are not paid. And taking this and breaking it down a little bit more, where fees aren't paid, as things stand, schools would be able to make a claim for bad debt relief. HMRC has confirmed that this will be available to schools in the same way as it is to other taxpayers. So whilst this is technically true, it's important to note that there's a couple of qualifying criteria that need to be applied. Firstly, bad debt relief can only be claimed 6 months after the payment was due to be received. And secondly, the debt has to have been written off to a separate bad debt account. It's also really important here to highlight, and why big part of the reason why the VAT inclusive invoices are important, is that where a VAT only invoice has been issued, so effectively if the school has issued a fee plus a without VAT and has then issued a VAT only invoice to collect the VAT, the bad debt relief claim is only actually valid for for 1/6 of the actual VAT-only invoice. This is because the VAT-only invoice is effectively treated as a gross amount. That sounds like a little bit of a strange provision, but it is definitely an approach that HMRC do apply. With all of this in mind, schools that have significant numbers of pupils with EHCPs that are funded by local authorities would be wise to consider approaching those local authorities to ensure that they are expecting and are ready to process those VAT invoices and will be ready to pay the VAT on the fees charged. Where the school's not in possession of its VAT registration number, it's also probably worthwhile raising with the local authority its intention to issue VAT-inclusive invoices. That's just a quick overview of a specific issue that has been talked about quite a lot over the last week. It's probably worth just raising a couple of broader points, and I know, Ellie, that these have been talked about a lot in the press. Just in terms of the broader impact of this policy and its interaction with local authority funding, budgets and cash flow, as well as broader SEN provision. Whilst the VAT charged to local authorities will be recoverable from HMRC, it's entirely possible that there could be a short-term cash flow impact in the intervening period. Additionally, I think the fact that the VAT charged by schools will be recoverable from HMRC does mean that in the case of EHCP pupils, the policy doesn't really raise additional revenues. Money is effectively just moving between central and local government budgets. A final point worth noting on the implementation of this policy in the context of SEN provision is that this all sits really uneasily alongside the conclusions of the National Audit Office report that was issued in October 2024 into the support for children and young people with special educational needs. This report highlights the demand for EHCPs has increased by 140%, whilst at the same time the DfE estimates that some 43% of local authorities will have deficits exceeding or close to their reserves by March 2026. Whilst a lot of these issues predate the VAT change, it seems clear that the whole of system reform that the NAO recommends will need to factor in the introduction of VAT, its impact on SEN provision, and the role played by private education providers in order to actually really get a true picture of how to improve the system.
Thanks, Gabby. So there's lots to consider there, both from a practical and policy perspective. So it'll be interesting to see how this continues to play out, given really the quite rushed implementation. Moving on to a tax factor favourite topic, non-DOMs. I won't go into it too much because we've talked about it quite a lot. But a recently published article discussed that tax advisors and lawyers say that there is good evidence that a significant number of non-DOMs are actually selling up in order to leave the UK before April. This would be to, in their words, escape inheritance tax under the changes that were introduced in last month's budget. So as a very quick recap, the old system was that inheritance tax previously only levied on non-DOMs UK assets will be abolished from the start of next year, so April 25, and will instead be imposed on people's UK assets for their first 10 years of residence in the country, after which it will apply to everything, which includes overseas holdings. Those new rules will also require people to live outside the country for between 3 and 10 years before they are exempt from UK inheritance tax on anything outside of the UK. Rachel Reeves said that these reforms were expected to raise approximately 12.7 billion over the next 5 years, but unfortunately the Office for Budget Responsibility have said that these estimates are, and I quote, highly uncertain. However, if someone does emigrate in the current tax year, they will reduce their exposure to UK IHT on their worldwide possessions to basically a maximum of 3 years. So the problem with these changes are they are essentially saying, if you want to go, you have to go now.
It's really interesting, actually, because even at Blick Rothenberg and amongst other advisors we know, we have heard of a lot of non-DOMs who were talking about exiting the UK or actually exiting even before the budget. Interestingly, in the article, though, Emma Chamberlain, a specialist barrister, mentions that a lot of younger non-DOMs are actually less worried about a long period of exposure to IHT and actually more likely to buy insurance to cover the risk of death duties. This sounds to me like many younger non-DOMs may be taking a longer term view and are happy to potentially ride out the storm of successive governments and who may take a different view on IHT. So, moving on to another favourite topic, certainly one that's again dear to my heart. I'm having a great day, Ellie. Making tax digital. This is the project which is a key part of the government's work to digitise the tax system. And it began with VAT and has applied to all VAT registered businesses since April 2022. But it will now be phased in for income tax self-assessment, also known as ITSA, from April 2026. Whilst this might seem like a long time away, the figures from your tax return for the 24-25 tax year will be used to determine whether you are in that first tranche that will need to comply from 6th of April 2026. Initially, it's planned that this will apply to individuals who carry on a trade, so the self-employed or sole traders, and or people who rent out property, so landlords. As I mentioned, the start date is determined by total turnover or gross income, which is the combined sales and rents from all trades and property businesses. An individual must comply from 6th of April 2026, where their annual turnover exceeds £50,000, and from 6th of April 2027, where their annual turnover exceeds £30,000. If this does affect you from 6th of April 2026, you're going to need to do a couple of things. Firstly, you're going to need to maintain digital accounting records in a software product or spreadsheet, so you won't be able to maintain paper records anymore in order to comply with the legislative requirements. And secondly, you'll need to submit quarterly updates to HMRC and finalise your tax position after the end of the tax year. So the quarterly updates will need to be submitted using a functional compatible software product that can access and interface with HMRC's platform. This means that you'll need to buy a suitable commercial software product or appoint an agent in order to submit that information to HMRC in a compliant manner on your behalf.
Thanks, Gabby. And as you said, these changes will deviate quite substantially from what many sole traders and landlords have been used to doing for many years. So they will need to be really careful when considering whether this, well, firstly applies to them. And then if they're not sure, they really need to be seeking out that specialist help earlier rather than later. And for our final piece today, a really interesting story. So not one that we often come across, because when we're looking at tribunal cases, you have all the information. So, you can be quite nosy. But essentially, the Upper Tribunal has ruled that a taxpayer involved in a dispute with HMRC over unpaid taxes cannot remain anonymous forever. And the reason they gave was because the taxpayer had not given any good reason as to why it should be kept a secret. So when I was kind of looking into this, the UK judicial system relies on the legal principle of open justice, and all tribunals are conducted under that principle unless there are very exceptional circumstances. So say a taxpayer might be under threat, or there will be some kind of risk to them or their family if their identity was revealed. In this particular case, they do know that it is a man. So when the taxpayer in this case realised that his identity would be revealed, he'd actually already been to the FTT and he settled his tax dispute with HMRC because he didn't want his identity to be revealed. And it related to, and they put, quote, certain tax deductions, whatever that might mean, and then went back to the Upper Tribunal to claim lifelong anonymity via an anonymity application. From here, many news outlets applied to the Upper Tribunal, arguing that the identity of this taxpayer should not remain anonymous and should be made public. But then the taxpayer made an application at the same time to the Upper Tribunal to continue this anonymity. Again, that would be sort of indefinitely. So the application had stated that the taxpayer had decided to withdraw his substantive appeal to the FTT against HMRC's tax demand. And I quote, in those circumstances, he ought to be permitted to retain the existing anonymity. And the representative argued that the very process/procedure of applying for privacy should not be what causes the privacy to be lost. And this was the only way to ensure the effectiveness of the Human Rights Act 1998, Article 8, right to privacy. However, the judge did say, and again, I quote, in the present case, it is striking that the taxpayer has at no stage produced any evidence of potential harm which is said to have justified either the application to the FTT or for the anonymity application itself, and therefore refused the application on the grounds that it's not clear how the rights of that taxpayer will be breached, and whether it's necessary and proportionate to interfere with the ordinary rule of open justice in order to allow this anonymity. So the individual has until the 11th of December to appeal his decision, and they need to take the claim to the Court of Appeal or their identity will be revealed.
Wow, that's really interesting, Ellie. I'll definitely be looking out for that to see if they actually appeal the decision. There have been so many examples in recent years of super injunctions, excessive NDAs and the like, and the principle of open justice shouldn't be undermined without good reason. But at the same time, the fact that judgments of our courts and tribunals are published has always been a point that taxpayers need to be aware of when they're embarking on litigation. So definitely a space to watch there.
Definitely, I'll be keeping my eyes peeled.
Your weekly tax update from Blick Rothenberg.
But that's about all we have time for this week. Thank you to Gabby for joining me on her very first Tax Factor episode. You've done amazing. But in the spirit of a good cross-promotion, I should mention, if you enjoyed this podcast, or maybe even if you didn't enjoy this podcast, please try our sister podcast, Brave Business. Hosted by journalist and broadcaster Declan Curry, we've just released a new episode looking at neurodiversity in business. Joining Declan are Blick Rothenberg partner Gail Cobley, Binna Candola from consultancy Pern Candola, and Ben Branson, the founder of Seedlip Dricks and the Hidden 20% charity and podcast series. If you've watched our Success Stories episode with Ben, you'll know that he's super interesting. Brave Business is available everywhere that you can get the Tax Factor and also on our website, as are the Success Stories episodes featuring Ben. Just search for them on the homepage. Next week, Blick Rothenberg CEO Nimesh Shah is back along with another new voice of the Tax Factor, Mally Kinney, so no pressure there.
We release a new episode of Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen to it wherever is most convenient for you.
If you enjoyed the podcast, please subscribe and give us a rating or review. Thanks for listening, and we hope you enjoyed the episode.
Goodbye.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on the Tax Factor.